Alrighty,
Hey.
and we are live. So, hey, my friends, it's Andrew Michael. I hope you're doing well, having a great day. If you're watching us live, do me a favor, throw a comment down below and just kind of let me know where you are. Just always kind of curious. And I have with my friend Scott Goldstein. Scott, thank
Thank
you
you
for
for having
joining
me.
us.
Absolutely. Thanks for having me.
Of course, of course. Now you are the president of Atlantic Trust Mortgage.
That is correct.
Cool.
Yep.
So you are a loan officer and you're the president of your own loan brokerage, correct?
Yes. Yep. We've been in business almost 22 years.
22 years. Well, there you go. In your industry or mine, that's hard to accomplish.
It's been a long road.
Yes, sir. So perfect. All right. And so where is your office based out of?
So we're over in Nocatee in Ponte Vedra, Florida.
Okay. Very good.
Yep.
Cool. All right. And by the way, if you're watching this video, either live stream or later on, I'm going to have Scott's contact information down in the section below. So feel free to reach out to him directly if you wish. And without further ado, let's jump on in. All right, sir, you ready for our first question?
I am ready. Hit me up.
Perfect. All right. Can you purchase a home with a mortgage if you already have a mortgage on your current home?
Absolutely. So a lot of people, what they will do is they own a home, they want to convert it to an investment property and then purchase a new primary residence. Then we can use rent to offset that mortgage. So typically what we need is a 12-month lease and a copy of the security deposit and first month's rent. And whatever that rent is, let's just call it, $2,000. We can use 75% of that as additional income to offset the current mortgage on that property.
Okay.
Yes, you can.
Okay, so that's if I wanted to rent out my current house.
That's correct.
And buy another one. Okay. Now, how do you determine? I believe it's called the debt to income ratio.
Yes.
So it's possible if somebody had enough income to offset the debt of both homes, then they could actually do that. Then, correct? They wouldn't even have.
Then we don't even work if they qualify carrying both mortgages. We don't even need any other documentation. But if their debt ratio is a little bit on the higher side and we need additional income, then we can get that lease and use 75% of it.
Okay. So let's say, for instance, somebody owns a home somewhere else, let's say in Virginia or DC or wherever. Actually, kind of is Virginia, but anyway. And they wanted to buy here, and then after that, turn around and sell their house up there. They could do something called recasting, correct?
Yes, that's actually become very popular. So, a lot of people like to take the equity from one property and move it to a new property. So let's just say you have a buyer, they want to, they just want to buy the home now. So they do 5% down.
Sure.
They're going to sell their home after closing. And let's just say they have $200,000 in equity and they want to transfer it. They do a recast. It's typically like a $195 fee. It's basically you are re-amortizing your loan based on the new loan amount and the interest rate when you purchase the home. So instead of having to go through a refinance and pay all the closing costs on a refinance, you just do a recast and it's like a $200 fee. And then they'll see their payment drop. So that's become very popular.
So the time we've used it here recently on our team is, if people want to sell their house, but they don't want to be in it anymore when it's being shown and all that stuff's going on, they'll go ahead and buy their house either here, in our case, it's here, and then they put their house on the market later. And then once they sell it, they bring those proceeds and cool. So when is it that a recast might not work for a buyer?
So you do have to qualify carrying both mortgages. So if their debt ratio is too high carrying both mortgages, then the purchase would now be contingent on the sale of their current home. So they wouldn't be able to do the recast.
Okay.
Yep.
Very good. Just wanted to post something there. There we go. Perfect. Okay. So those are some times when it actually wouldn't work for you. And okay. And now I think another time too is what I've heard. Recasting doesn't affect the interest rate.
It does not. So you keep the same interest rate from when you purchase the loan.
So like that, say for instance, it takes 5 or 6 months. By the time you move out, you do this, you do that. And normally 5 or 6 months wouldn't make that big of a difference, but we live in a weird world at the moment.
Yeah.
So who knows what's going to happen. So if the interest rates drop more than, let's say, like a point,
then you would want to look at refinancing.
Yeah. Then at that point,
then you can take your principal, apply it. But then you've got the closing costs. And on a refinance, the closing costs can be rolled into the loan, but you do have costs associated with it.
Okay.
Yep.
So very good. And by the way, if you're watching this live stream, be sure now, if you're on Instagram, I won't be able to see the comments until after we're done. But on Facebook or YouTube, if you're watching this, then go ahead and throw a comment down below. And also, I'd be more than happy to answer it. And yeah, and also be curious where you are. Last time we did one of these, we had somebody in Ireland who was
Nice.
watching us and looking to move over
Going
here.
worldwide.
What's that?
Going worldwide.
Going worldwide. There you go. Cool. All right. So the next question that I have, and these, by the way, are the most commonly asked questions that we get from our buyers who are calling us off of our YouTube channel or relocating. So let's see here. All right. So most builders have what they call their preferred lender, their in-house lender, you know, that kind of thing.
Yep.
Is it a good idea to use the in-house lender, and what are the trade-offs, pros and cons, you know, stuff like that?
So it does depend on the builder and the builder's preferred lender. So typically, I mean, you know, they say nothing's free. So where is it built in? So a lot of times the builders will kind of bake that into the sales price if they're giving the incentive. So we are preferred lenders for a few builders here locally in Jacksonville, and we will give a 1% of the loan amount credit towards closing costs. You will see other builders where they'll do a rate buy down. So maybe they're offering, if current rates are at 6.5%, they're buying it down to 4.5% to make it very attractive to sell their products much quicker than a resale. So in doing that, that could have a $20,000 or $30,000 cost to buy it down 2 full points, depending on the price point. So what you will see is you'll see maybe, you know, $15,000 or $20,000 in points, and then the builder is covering that on their behalf. So it just depends on what the incentive is and who the builder is.
Okay.
Yeah, but it's baked in somewhere.
It can be baked in. So when you're saying it's baked in, the scenario you just laid out, the builder's paying for it. So in which case that works for the buyers.
Correct.
I've seen previously where the lender, the interest rate was a smidgen higher, but they were paying closing costs.
Yeah. So if I were to cover your closing costs, then I would have to offer you a higher rate, because in doing so, then us as the lender, we're getting a higher rate, so we can offer a lender credit to cover closing costs. So it depends on who's covering that cost for the buyer.
Gotcha. Yeah. And when we bought our home, which was 10 years ago, last summer, it was already pre-approved with an outside lender. And we ended up using the builder's one because when I looked at it, the interest rate was a little higher, but I would have had to have, it was like a smidgen higher. The payment was a smidgen difference, but it wasn't much.
Yeah. I had a buyer here locally that he was going to use the builder's lender. The builder's lender. And he was shopping around, and he ended up going with us because we were still an eighth lower in interest rate and about $2,000 lower in closing costs. And because it's the builder's lender was charging a lot of points to get the rate, because they feel like they're going to get the deals, so they'll charge more in fees. But then when the client shops around, they find out they can get a better deal. They move on elsewhere.
Cool. And the was that one of ours?
No.
Oh, because I know the same thing happened with Kylene. Was the
yes. I'm sorry. That was yes.
Yep. There you go. So it's like I know the story here actually.
Yeah. Yep.
Cool. All right. Since it wasn't one of my questions, but you kind of brought it up, and when you said shopping around, what I have seen is I had a sale not too long ago. I was working with it, and that was they were buying a new construction home in Southern Pines, and you know, he told me what he found online, and the interest rate was like stupid low. I haven't heard anything like. I was like, what is this? And so when he got neck deep in the application, he saw it like on Lending Tree or something.
Yeah.
And then when he got neck deep in it, it was actually a way worse deal.
Yeah.
I guess they kind of figured by the time you got that far into the process, you just say, oh, okay, you lied to me, whatever. So what is it when people are shopping around? What are some tips that you have for that?
So the biggest thing you want to look at when you're comparing lender to lender, okay, is lender fees and interest rate. Because all the other costs, your title fees, your transfer fees, your escrows, those are all going to be relatively the same regardless of the lender you use. So what you'll see a lot of lenders do is advertise low interest rate. So right now rates are around 6.5%. You'll see somebody advertise 5.99. Okay, and you think, wow, that's great. But what fees are associated? That's what you want to really look at. When you get a loan estimate, there could be 2 or 3 points. And if you're at a $400,000 price point, you could be paying $8,000 to $12,000 in fees to get that interest rate. They don't disclose that to you, like you said, till you're knee deep, already in contract and moving forward. And you may not have time to shop around at that point. So really, you want to do your shopping before you go into contract. That way you've got enough time to make a decision on who you're going to use and move forward. But it's the lender fees and interest rates, because the only thing I as a lender can control are the fees I'm charging.
Yep.
Yeah.
Gotcha. Okay. So now let me ask you another door that just opened. Okay, so basically they're charging points, which is prepaid interest. Okay. So most people in Florida are not, like, let's say you buy a house with a 30-year mortgage. You're not going to have the house for 30 years, and you're definitely not going to have the mortgage for 30 years. So if you're buying down the interest rate for the entire life of the loan, and then you end up refining, selling the house, whatever, then you just kind of, just basically
that's a lot of money.
Yeah, that money was down the drain. So yeah.
Yeah, typically what we look at is how long it's going to take to recoup that money. So good rule of thumb is 2.5, 3 years. That's
okay.
That's an approved. I would say that's a good deal. If it's taking 5 or 6 years to recoup the money, it's not worth the rate buy down. Yeah.
No, this is for sure. Okay, so let's move on to the next question. You actually kind of already answered it, but in fact, you did answer it. It was, can you rent your current home and use the rental income to offset the cost of your mortgage? Since you've already answered that question, let me ask you a different one. With VA loans, no, we don't just work with VA. We work with conventional. In fact, the one that we were just talking about that we're working on together, you're working on with Kylene, an agent on our team. I think that's a conventional mortgage, if I'm not mistaken.
It is, yeah.
Okay, but with VA loans, that can get a bit tricky because you can only have so many VA loans out at a time.
Yeah, so you can have, it's a myth, you can actually have more than one VA home loan. So as an example, you have somebody that owns their primary residence and they're moving and they want to buy another primary residence, okay? You can rent out your current home. You don't have to refinance out of it to into a conventional loan. You can use your bonus entitlement for a VA loan. So we will actually pull the veteran's certificate of eligibility and see how much entitlement he has left. And then as long as he qualifies in the price point that based on the entitlement he has left, he can have a secondary VA home loan.
There you go.
Yeah.
And so what is the max amount that he or she can buy with a VA loan?
So the conventional loan limit is typically where it's set at $806,000. But we're a broker, and one of our lenders, I mean, you can do 100% financing up to $2 million. So
it's kind of a trick question.
It's a VA jumbo loan at that point.
So, but there is no, in theory, there used to be a hard ceiling. Like I think it was 425 in this market back in the day.
417, yeah, because that was the old conventional loan limit. Yeah.
Yep. And then eventually so now there's certain lenders that'll put a cap, like the one you just mentioned. They just won't loan more than 2 million, but in theory, the VA doesn't say.
Right.
This is all okay.
Yeah.
So how does that work exactly then?
So, I mean, I did one for a family member. They bought a home for, I think it was like just under 1.6, and they had their full entitlement. So they could do 0% down, $1.6 million loan amount, and VA interest rates, government interest rates, are typically about 0.5% lower than conventional. So they are able to get a great interest rate. The downside, and I don't want to say downside because you're getting 100% financing, but the downside or the negative to a VA home loan is the funding fee. So unless you're exempt from the funding fee, it's rolled into the loan, but it's still an added cost that's rolled into your loan.
Cool. Yeah, in fact, that brings up another good point. So I have a 10% service-connected disability from the VA, and so I'm exempted from VA funding fees.
Yep.
And so I can't really imagine a scenario where it wouldn't benefit me to use a VA loan over a conventional, even if I was putting 20% down.
Yeah, because the VA rate's going to be about 0.5% lower.
Yeah, so I get that sometimes because again, like when you use a VA, now different veterans have different what do you call it? Like they served in a different time period, so they have a different funding fee, I think, or if they're reservists, first active duty.
Well, so it's whether or not it's your first time using the VA loan or subsequent. So if you've used your VA loan before and you're using it for a second time, the VA funding fee is a lot higher.
Okay, but for those of us veterans who have the service-connected disability, it just doesn't exist.
You're exempt. Yep.
Cool. That's one of the things about VA loans.
Yeah, we do a lot of VA loans. I mean, there's obviously in Jacksonville, there's a lot of military bases, so we do a lot of VA loans.
Okay. So next up, and this is a bit of a controversial one. We don't talk about politics here, but who sets the mortgage interest rates? Is it the Fed?
So the Fed does not actually set the mortgage interest rates. So not directly. Okay. So, when and this is such anytime the Fed cuts rates, the first call we get is, oh, I saw, it was cut a quarter or half a point. Where are rates today? They're the same as they were yesterday.
Yeah.
So typically it's the 10-year treasury that kind of tracks along with mortgage rates. So there's a lot of key indicators on what affects interest rates. The reason that we saw interest rates jump so much in the past 3 or 4 years is because the government stopped buying the mortgage-backed securities. So when they stopped buying the securities and the public was buying them, or privatization, then you saw mortgage interest rates increase. Inflation is another key indicator. So as inflation continues to come down, we should see mortgage rates come down. So, when the Fed announces that they're probably going to do a quarter or 0.5% rate cut, in the next quarter, it's already baked in by the time we get there. So we'll see rates kind of trickle down. And then when they do announce it, it's already factored in. Now, if they announce it, a 0.5% rate cut and it's a quarter and we've kind of baked in a half, now we see rates can spike up a little bit. So it's more economic data that drives interest rates in the 10-year than it is the Fed, cutting rates.
Well, each lender, though, can set their own mortgage rate, correct?
Well, they do, but currently, 99% of all conventional loans are purchased by Fannie and Freddie. Okay. And so even though they can set their interest rates based on the premiums they want to get, we're a mortgage broker. So we've got, 30 or 40 national lenders we work with. And when we're shopping for a client, we look at our top lenders, and you've got, one of our lenders here is at 6.5%, and then you've got another lender at 6.375. It's because they're trying to make a little bit more margin, so their rates are higher. So yes, they can set their own interest rates, but they have to also be able to sell these on the secondary market. And that's where the pricing really comes in.
Okay, very good. Let me just check something real fast. There we go. All right, cool. I'm just trying to check in on our different little streams, just making sure everything's going well. All right, so we answered that question. And let me move on here. You kind of alluded to it a second ago, but what is it? You are a mortgage broker.
Correct.
What makes you different than, let's say, like a bank that loans, or a normal a loan officer, that kind of thing?
Sure. So you go to a bank or you go to a direct lender. They have their set of programs and products. If it fits that box, they can do your loan, and they have their set interest rates. Me as a broker, I've got 30 or 40 national lenders. So I've got 40 national lenders, their different products and programs that we can sell. Now, if you go to a retail bank, I'm a wholesale lender, and everybody knows anything wholesale is going to be cheaper than going retail. And so we can offer lower interest rates and lower closing costs, and we have more options. So as people like to shop for their mortgage, we can actually do that shopping because we've got 40 lenders I can shop through. So we're kind of like a one-stop shop. Your client doesn't have to have their credit pulled 4 or 5 or 6 times to go shop with different lenders. We pull their credit one time, we do their application, and then I can shop for the best interest rates on their behalf.
Okay.
So it gives our clients more options to say yes than being turned down, because you can go to a Bank of America or Chase or any other bank, and if they have more conservative criteria to meet, they may not be able to do the loan, where some of our lenders may have a little bit looser guidelines.
Yeah, I encountered something like that once. I had buyers who, I think it was the same thing, if I remember correctly. One of them was a veteran. I don't remember if it was the husband or the wife, but one of them was a veteran. They had a service-connected disability. And when they talked to the loan officer, they said that they needed to go conventional. And if I said the name of the credit union, you'd know it. I'm not going to. But, and I was like, I don't want to get too deep into the lending part of it, but that just didn't make sense to me. And it turned out it's because that credit union was not allowed to do VA loans.
Right.
And so they were just selling what they had. Yeah. And it's like, no. It's their call, not mine. But I just made sure that they knew that that's what was going on.
Yeah. And it's really, when you're speaking to a lender, it's our job to give you as much information to where you can make the decision on your behalf of what's the best type of loan for you. Not me to say, you need to do a VA or you need to do conventional, you need to put this down. It's, let me give you the options that you have that you qualify for. I'll give you the pros and cons of everything. You make the informed decision, and then we move forward that way.
No, for sure. Yeah, there's a few times when I think you kind of have to. Like, I've seen one that was going FHA. It didn't make a lot of sense to me, but then I found out the debt to income ratio, that was the problem. It's like, okay, yeah. So then it made sense. So cool. All right. And let me see here. Is there anything else that we haven't brought up that would be of interest to people relocating to Northeast Florida? Oh, I got one for you.
Yeah.
New construction homes. Can you buy? Sometimes I get a lot of questions because in other parts of the country, they do more of a construction to perm loan.
Yeah.
You know, where you go, you buy your vacant lot, we bring a custom builder over, we close on the lot while we're doing all that. Okay. So basically you own the land, and then the builder comes and builds their house on your land. And then when it's all done, it becomes a conventional, a VA, whatever. But that's not normally how it works here. Here, the builder owns the lot.
Yeah, typically here, the builder, they own the lot and they finance their own construction. So we're just doing a standard end loan. We just, it's a new first mortgage. But, there are times where people will either purchase a lot and then they want to build their, they'll find a builder and build on it. And it's a construction perm. So the reason it's a construction to perm, because it becomes a permanent loan at the end.
Yep.
We don't do a ton of them just because more of the big builders buy up all the land, and, but we do have people that will come to us, and it is a product that we offer, and it's a good product. It's a different process, and a little, when I say trickier to get done, there's just so many moving parts because the builder is obviously heavily involved. But it is a good loan program. If you own property and you want to build your own house and you can find just a small builder, then they can do they can build it for you and we can finance it.
There you go. Yeah, I've only done them mainly in rural areas because, like you said, like if you're going into Nocatee, you're going to Seven Pines, you're going to Silverleaf, you can't do it. The only community off the top of my head I can think of would be Palencia, and then Nocatee's River Landing.
Yeah.
Because
River Landing. So that is one where you can, and I think they've got like a list of 5 or 6 builders, but it would be a construction perm one.
Yeah. So cool. All right. And so last but not least, most important question of the evening. Are you a barbecue guy? If so, what kind of stuff, what's your setup like?
So love to grill all the time. My kids love it. So, obviously we do the steaks, but we do tons of fish. We do bone-in chicken. You name it. We
like a rotisserie or?
Not a rotisserie. We just, I have that actually on my grill, but we have the infrared. I've never used it, but it's on there.
What kind of grill do you have?
I think it's a Somerset.
Okay.
It's a like in a summer kitchen setup type of thing.
Oh, okay. So the summer kitchen, just so our viewers understand, it's not like a freestanding grill. It's built into the patio. Okay. Yeah.
But love charcoal. Like charcoal grilling is the best.
Okay.
But I don't have that. So but we grill anything and everything, put veggies on there, and love it.
Yeah, we do. So I had 2 Weber grills. I had a Weber propane and a Weber charcoal.
Yeah.
Just depending on what I would do, and then I'd wheel it out, just whichever one I was using. I just got rid of them. And I think I'm going to go with the Napoleon, but it's got the, it has the infrared on it.
Yeah.
It has the rotisserie and the infrared, and it has an infrared burner.
Yeah. Yeah. That's what mine's got. I've never used it. Don't even know how, to be honest with you, but.
Oh, really?
Well, learn it and figure it out.
Well, the easy answer is go to YouTube. I was watching YouTube videos all weekend on looking at different things, but cool. Well, that was my last question. I appreciate it. So if you got anything out of this, do a favor, throw a comment down below, and we try to go live every Monday. So if that's something you're interested in, definitely subscribe to the channel, and I'll have Scott's information down below if you want to reach out to him directly. Looks like I got a little.
Thanks for having me. I appreciate it.
My pleasure, sir. You have yourself a great day, and
you too.
We'll talk soon.
Sounds good.
All right.
Thank you.